I'm going to give you the standard kind of academic approach that the stock market should be representing, so the present discount value of future
All right,
future
what do you
earnings.
think about the stock market? Because seriously, financial conditions have become, and financial stability has become a huge part of what the Fed is obsessed with since 07, 08. And there are people who say maybe inflation wasn't a problem back then. They should have raised more quickly. They should have done more to lean against these bubbles. What do you think about financial conditions today?
Well, certainly there's a lot of enthusiasm in markets, and also the thing that probably worries me the most is people don't seem to be worried. So if you look at various volatility measures, whether it's the VIX or risk spreads, they seem to be very low, and I don't see why they shouldn't be at least average. It's, given all the geopolitical risks, given a lot of uncertainty with respect to policies, but we are seeing a synchronized global growth period, which is really quite rare, and I think that's one of the key offsets of why both the market in the U.S. and markets globally are doing so well.
I was sort of joking about this, but maybe the Fed should come out and do an intra-meeting rate hike just to wake everybody up and
keep us on our toes,
keep the market on its toes,
that'd wake people up.
We might be positive by the end of the session that day. I mean, the way that sentiment is, but explain what their thinking is about being so cautious in this environment.
So I think there's a lot of uncertainty about where inflation is going. We just got an inflation report this morning that suggests there's a little bit more inflation, but not too much. And so it's basically getting to where the Fed wants it to be, which is inflation around 2%. I think the Fed has been surprised in how slow it's been to get there, but it's not unique to the U.S. In Europe, inflation has been very low. Most countries, inflation has been lower than expected. So they are trying to raise rates in anticipation of inflation coming. But if it were all just sort of Fed stimulus driving the stock market, you would think that the stock market would have come off a little now, because the Fed has raised rates considerably without a real negative impact on the markets. And it's clear where the ECB is going to go. Bank of Japan, I think, is a different story. But at least in Europe and the U.S., it's clear. And the market hasn't pulled back yet.
So do you think we're going to have a serious discussion about changing the inflation framework targets? Are we in an environment where demographics or technology are lowering that natural rate?
So I think it's really important to have that discussion. And at the most recent the American Economic and Finance Association meetings in Philadelphia, as well as there was a recent Brookings conference on this issue. So I think it's very important to have the discussion. I can't see the Fed making a change now. Part of the issue is, it's only a few years ago that the Fed explicitly put out an inflation target, and that's supposed to increase credibility. If every few years you just say, oh, well, my target's up, my target's down, it doesn't really help with credibility very much.
Are they in serious jeopardy of losing the public opinion that says, oh, they aren't controlling inflation? Because nobody cares right now. The general sense is it's low, it's fine. You don't see people in public surveys going, you know what, it's only 1.3%. I don't trust this Fed. They can't get the job done. The trust actually seems quite high. What's the big deal about, a couple decimals of a percentage point here?
Well, I think that's exactly right, because in the old days it used to be like 2 versus 4%.
Right.
That was kind of the issue, and trying to get it down to 2 is very important. When we're starting to talk about a few decimal places, to say that the Fed has that much fine control to get it 1.8 versus 1.9, I mean, that's asking an awful lot of our models and of the Fed.
Early days here in trying to digest the implications of tax reform, of course. Yesterday, the Treasury Secretary talked again about $1 trillion increase in revenues, or revenues contributing to $1 trillion. Where do you come down?
So I think I haven't been able to get my hands around the magnitudes yet, because there's so much that's going on in the tax reform, and it was so deep. But I do think the direction is generally a positive one for the economy, both in the short run and the longer run. Because you have a reduction in personal tax rates, which will help to boost disposable income in the short to intermediate run. And then I think a lot of the reforms are really focused at trying to increase investment, because we've had a very slow investment recovery. And so I think if you have better investment incentives and a more investment-friendly regulatory environment, you're likely to get more investment, which will lead to higher productivity, and that increases long-run growth. That's sort of more on the supply side. So, now, how much? I'm not sure.
I was going to say, you think the incentive is there to do, say, CapEx with utilization rates where they are? I mean,
so On the margin, it'll be helpful, and certainly with expensing coming in, I think you're going to see some increase in investment. But that's really the key issue. How much of a response are we going to get? And that's why I'm reluctant to say that I know what the magnitudes are, because this is a somewhat unusual circumstance, and it's hard to just use past data to say, aha, it's going to be 0.4 or 0.6. But I think the direction is fairly clear.
Synchronized global growth. We heard from a number of our guests. You mentioned it's somewhat of a rarity. Do we have any historical information in terms of how long these periods typically last, or what they lead to?
So I think there's no consistent pattern. You'll get short periods where it'll be positive. It's rare that you get so many pieces, whether it's China, Japan, because Japan is actually growing. I know we usually think of Japan as being a basket case, but they're actually not nearly as much as I think many people say. The Eurozone, US, that's rare. I think that just doesn't happen all that frequently, for a few months, but we've had sort of 18 months of this, and the prospects are for more of it going forward.
Go ahead. Yep.
Implication being what? I mean, continued good times, let them roll. To your point earlier about central banks, they're just going to continue to kind of roll along with it?
Well, no, I mean, central banks like the U.S. Fed is trying to raise rates in anticipation of higher inflation. Also, it's not like growth has really skyrocketed. We've had growth of 2%, and now we're getting closer to 3%. That's not wild. I mean, it's good that we're growing more, but I don't think it's sort of economies or central bankers gone wild. Europe is actually growing a bit stronger. I think there is where the economy is going a little wild.
For them, it's a tear. They're on a tear,
yeah,
relatively speaking.
I mean, they have very low growth of the labor force. We at least have a positive growth of the labor force. Many countries' labor force is shrinking. And to have growth rates that are similar to the U.S., that's pretty unusual.
Central bankers gone wild. That's going to be a new primetime show, I think, on CNBC.
But I want that mental image of rates right now.
All right.
9 o'clock, after the profit.
That might affect who you want to be on the Federal Reserve Board.
That's true.
Mr. Kroszner, thank you very much. Good to see you. Appreciate it.
It was great to see you.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.